Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. It is just general in nature only. We are now locked into how the Fed is going to operate. I think you need to put out there very clearly that they are not going to go down the path that the market was really pricing in, which is really big astronomical jumps. What they are likely to do, though, is to go on a smooth, consistent transition up. They are going to raise rates. We know that. And Powell has now even said that twice, but particularly in his testimony last Thursday, that said he would prefer 25 basis point rate hikes. Has said that if he has to, he will go harder. But I think what they mean by that is that they may actually just do 25 basis point rate hikes every single meeting until they get to a point that they start to contain inflation. It is smoother. It's much more understandable. It gives them line of sight about exactly what they're doing and how it's impacting the overall inflation and economic outlooks. That's what they want to do, not the 50 bip hits that some people are forecasting. I just can't see them putting a handbrake that hard and that fast. It just means that you get a really disconnect between what you're doing and how you're going about it. So that's what was going to happen when we see on March 16th for us here in the Australian region when they release. They're going to raise rates by 25 basis points, and we now know that. That is locked in, and that should be how you should look at it from a playbook idea going forward. But we do know that's not the only thing that's going on right now, and that it's not the only thing that's going to impact FX. The Ukrainian crisis is only going to get worse, in my opinion, over the next couple of months. And the way to look at it is the euro. The euro is now at a 20-month low, and it hit 110.11 on the back of news that there was bombing at a nuclear power plant in the southern part of the country. Those kind of headlines are not going to go away. It also means that the euro is going to be your beacon of understanding how the crisis is playing out and where the market is positioning. Momentum also tells you that it's to the downside as well. And the euro is suffering against everything for very obvious points. And unfortunately, that at the moment is where FX is going to concentrate most and where most trade is flowing.